And thanks everybody for joining me tonight. This is the second of a series of um, lectures on personal finance. And, I think the first one that we did go over was to set the foundation as to why personal finance is important in your overall well-being, because it dictates how much you're going to work, where you're going to work, and how much time you're going to spend. And I think we also spent quite a bit of time trying to have you think about what is it exactly that you want to do, because now that you've committed so much time and effort and energy into a career that's going to consume a lot of your time for the next however long it is, 20 or 30 years, you want to be very intentional in terms of choosing what you want to do, where you want to do it, with whom you want to do it. And the other thing is also finances play a big role in that. It goes without saying that the reason why we do go out and make a living is because we have to fund our needs and fund our lifestyle. So number one, you want to be responsible and knowledgeable about how you manage your finances, because that will dictate how much you work, where you work, and when you work. And then the second thing is, when you do work, you want to choose something that is aligned with your values. So today, I wanted to talk about laying the foundation, which is more about debt reduction, because I think that's a big thing. We have a debt crisis here, both as individuals and as a country. And so to just give you some awareness about that. So, the first thing to do is to address that, recognize it, and have a game plan based on what types of debt that you have. And then there's a kind of a non-glamorous topic, but it's foundational. And when we talk about asset protection, it's really when we're talking about insurance. So, what is the safety net that we have in the event that something happens to us, our property, or with life insurance, with disability insurance, because you are your greatest asset. We talked about the different assets versus liabilities. So debt's one big are a bunch of liabilities. Assets are not only things that you own, but things that generate money for you, but also yourself, which is probably the greatest asset of them all. And then I'm going to kind of close things off by talking about financial planners, because probably some of you have already signed on with financial planners, or you're being approached by financial planners. Even to this day, I'm still getting approached by people that are wanting to handle my money. And when they want to handle my money, they are also looking to take their share of the assets of my money that they're handling, which is, and we're going to talk about that as to what their role is, what are the things you got to look for. So again, we did the first lecture, why dentists should care about personal finance. Today is laying the foundation, debt reduction, asset protection, and financial planners. And then the next two, which is where we really get into the meat of things, is going to be talking about affording the dentist life. And it's a two-parter. So the first is about cash flow, because your lifeblood is cash flow. And when we talk about cash flow, that talks about, it's kind of a four-letter word, budgeting. Budgeting is kind of our what's going to dictate all of this. And people don't want to talk about budget, but I think if you don't do that, you're going to run into more problems and run into debt. And then financial decisions. I think one of the questions that we always get is, should I pay off my debt or should I invest? And so we'll kind of lay down a framework based on a number of different sources that I'm citing. And then we'll talk about savings and investing. That's going to be the last talk in this series 2 months from now. And so this is where kind of the fun, at least for me, the fun is how do you build that legacy? How do you build that nest egg? How do you build that portfolio of assets that's going to support you and your family for your future? So again, I always start every lecture with my disclosure. I am not a financial advisor, accountant, lawyer, finance professional, counselor, psychologist, or therapist. I also have no financial interests in the items mentioned in this presentation. However, I do own a real estate investing firm, which enables colleagues to invest alongside with us in assets. The assets in question are real estate. We also own real estate. So I do have a bit of a bias when I do talk about real estate as an asset that you can invest in. However, I am invested in all sorts of different type of asset classes. So, and again, this is for education and entertainment purposes. Everybody's situation is different. Please seek advice from a professional, but I will talk to you about how you identify professionals. So quick recap from last time, the value of your working time. If the average dentist made $180,000 to $190,000, again, after taxes, this roughly works out to about $10,000 monthly. If they work 4 days a week, 10 hours a day, 160 hours a month, this works out to roughly about $1 a minute. And so I'm reminding you again, and yeah, maybe this will go up a little bit later, but when you're thinking about buying something, taking on debt, quantify it to the number of minutes that it's going to require you to be be at work, sitting in your chair doing procedures. Again, certain specialties, such as I like to use the oral and maxillofacial surgeons, they roughly work out to about double that per minute. So they roughly work out to about $2 a minute. So, it's a little bit of a different game, if you take a specialty that does earn more. But again, that shouldn't necessarily be your sole determining factor as to what you do, because you got to make sure that it aligns with you and that it plays to your strengths. But the oral surgeons and perhaps the orthodontists, they probably sit at this range, which is double that of a general dentist after taxes. And then the last thing, in this recap was the article that I wrote about the value of your time that kind of breaks this down. It's a little, my math was a little bit different in this blog post, but then I quantified it into two major things that dentists commit themselves to. And I'm going to go into more detail on these things. But if you remember from the last talk, this particular situation, what I did was if a dentist middle career was to buy a home in Marvin, North Carolina, which is it's a high median income neighborhood or town that's adjacent to where I live. And there's a good number of dentists and physicians and lawyers and such. And they buy I think it was like a $950,000 home mid-career, 75% mortgage. The average dentist would be spending just to pay the mortgage. This doesn't include insurance, expenses, living expenses, food, all that, just for the mortgage. They'll be committing themselves to working for almost 10 years just to pay for the mortgage of that house. Let's see here. And then student loans, if we took the average student loan for a dentist and multiplied it by 2, and I'm going to tell you that, if your student loan's $300,000, you're probably, you want to plan on spending about $600,000 in the lifetime of the loan, unless you pay it off aggressively. And I'm going to kind of go over all those things. But let's say that you just did the average. They're going to spend about 9,000 working hours or 4.7 full-time working years just to service their loan. So between their dream home and their student loans, they're going to spend about 15 years devoted to that, working full-time. Of course, this gets cut down significantly if you're a specialist like an oral surgeon. And so this kind of takes us to, your dentists, physicians, lawyers, professionals, you're high-paying income earners. And a lot of individuals will think, well, if I just earn more, it's going to solve all my problems. Well, what happens is that you tend to earn more, but then you also tend to spend more. And so, well, I know I earn more, so maybe I'm going to get the nicer house, which is going to cost more. The mortgage on that house is a liability. The car, I'm going to get the nicer car. Well, that's another liability. And so you want to avoid being in the situation that the average person, many people find themselves in which they're already in a hole. All of their income is going into servicing these liabilities, which are expenses, and you're just constantly, these liabilities and expenses are really driving your requirement to work. And that's called the losing loop. And that's the situation for, unfortunately, a good amount of people in America, and it's not just limited to working class. So again, growing debt since 2009. 2009 to 2019, you could see mortgage has gone up, auto loans have gone up significantly, student loans, because of the inflation of student debt, has gone up significantly. Credit card debt, I think it's gone up even more than what's shown right there. Home equity line of credits, I think now with the crazy market that we're in, those are ticking back up. And then personal loans, basically individuals are taking out more personal loans just because credit is available. And retail cards, in terms of shopping, certain places like department stores, those are going up. That's gone up 51% since 2009. So we have a debt crisis. And this is why. So again, this is the keeping up with the Dr. Jones phenomenon, which I spoke about in the first lecture. You earn more, you get nicer income. You are under pressure to get the nicer house for your family, take the nicer vacations, eat the nicer meals, and then get finance for the nicer car. And as a result, you end up becoming a slave to your liabilities, and thus forced to work more. So so we talked about net, just kind of reviewing concepts. Your net worth is your income, or sorry, your cash flow is your income minus your expenses. But then your net worth is your assets minus your liabilities. And so what happens is you got your pretty much whenever you take on more liabilities, they become expenses for you. Some people will take on more liabilities, in order to fund a liability. So the example that I used last time was, taking out a home equity line of credit on their home in order to buy a pool in their backyard, and the pool in their backyard is not really earning them any money. It's a liability. So again, this is kind of what I called, and then you have a situation where you got COVID, and this is what I call the high income earners losing loop. And the situation we want to really work towards is increasing our income, decreasing our expenses, decreasing our liabilities, and increasing our assets. And so let's talk about the liabilities piece of it. And this is where I'm going to spend the first amount of time on. So when I talk about liabilities, I'm talking about debt. And so what are your biggest expenses? So number one, housing. And so, I was having a conversation yesterday with one of my residents, and, her brother was talking to her about, you should go in as soon as you graduate, you should get in and buy this house. And it was like $750,000 house, and, a lot of times we think, well, it's probably a good investment because it's going to go up in value. Well, you only really participate in that gain when you sell the house later on. Otherwise, the time that you hold it, it's a liability. You're paying to live in it, you're paying to maintain it, you're paying to insurance on it, you're paying taxes on it. And so the housing is, for most people, their number one biggest expense. And so we're going to, I'm going to talk about that in more detail actually in the next lecture. The car is this is probably the second biggest liability. And so, there's always I talked about having a student car when I was in college and when I was in dental school, and then you're anxious to get that nice car. And, I've had residents that are driving nicer cars than I am, just because they qualify for the loan. They qualify for a doctor loan because they're lending on their future earning potential because they've got that DDS behind their name. And then student loans, which I'm going to probably spend a good portion at the over the next few minutes kind of reviewing. And then credit card debt. And that's something that, people very easily can fall into a trap. And I'm going to kind of review some of the things you got to look out for, some of the things you got to pay attention to, and some of the pitfalls with it. So cars. So briefly during the pandemic, there was actually a temporary decrease in auto loan debt. But I pulled this today, and it looks like we're going back a long trend in terms of the overall trends in terms of increase in auto loan debt. And you can see between 2010 and 2021, we essentially exactly doubled the amount of auto loan debt. And what I heard was last year, there was a record number of individuals that are underwater in their car going in. So let's say they go in to trade their car, and they're trading it, and what they get in, they trade it in order to get a new car. And the car dealers, again, they're pretty savvy in terms of not really telling you total price. They usually will like to phrase it in terms of monthly payments. And so if you're buying a $50,000 car, that sounds worse than saying I'm going to pay $400 a month for the next 5 years or whatever. But they kind of like to manipulate it that way in order for you to get that nice shiny vehicle. And so there's been a record number of individuals that are underwater in their car payments. In other words, what they owe on the balance that they owe on their car is more than the trade-in value of the car, but then they're going ahead and trading in that car anyways to get a new car. And so there was a record number of individuals that were doing that over the last couple of years. And then they're even more underwater. So you're actually at a loss when you do that. Okay, so let me launch our first poll. And the next topic I want to talk about is student debt. And so here's the question I'm posing out to you. And again, I don't know who answers, we don't know who the answer is, but what is your student loan debt at the moment? So we'll take the next 30 seconds here. So half of you have answered. Some of you are probably just playing this in the background. You got 2/3, 3/4, going once, going twice. Okay, let's end the poll. We'll share the results. So we got, quite a good distribution here. And I think a lot of it, depends on what was your situation going in, if you had help from your parents or which school you went to, private school, state school. So it seems to be the winner is 250 to 500, and that kind of falls in line with what the national average was in 2019, which was roughly around 300,000. So, okay. So a little bit about student debt. You could see that, the amount of tuition, or the actual tuition for schools, has actually outpaced that of inflation. So you could see that this is dental school from the ADEA website. For non-resident and resident, essentially, for resident tuition fees, it's essentially doubled between 2000 and 2016. I would imagine that it's trended upwards even further than that. So I think essentially in the last 22 years, tuition has doubled. And the educational debt among graduating students, again, this data only goes up to 2016. It gets you to around, average is about 260, although I think in 2019 they said it was around 300,000. Again, roughly about, the small representative sample in this room here. And so student loans since 2007, have gone up. Basically, total student loans in the United States is 1.6 trillion now. Those were the latest figures. So it kind of goes beyond the levels that are here. So think about it, that all of the economic activity in the United States in the year is $21 trillion. So it just think about that. The amount of student debt is the equivalent of 1/20th of the total gross domestic product economic activity of the United States. And so, I went on some boards, and there were some questions, and I'll just kind of, that came up, and, basically they're just telling, somebody trying to make a decision as to whether to go to dental school. And basically their main concern was that they were, concerned about the large financial burden that they are going to take. And so they're saying, if I have $305,000 in loans, I'll need to work full-time in a high-stress environment for 7 years just to pay off the loan. Remember, I just did the math. I think we said roughly 5 years working. But it's something that they want to do. So they posed the question. These were some of the answers that they got. And so one said, I would not attend dental school if it cost me 300,000 plus. How do you start a family? How are you going to, here's a good thing. How are you going to try and stay ethical in your practices and be less production driven if, if you're kind of driven by production? So this person said 200,000 is their threshold. Here's somebody that was newly graduated, and they said their husband had 300,000 in debt, went to work, grinded it out, working 6 days a week, made good progress on their home, have a son, basically, that's just one situation right there. And then another one in the commentary on that, to answer that question, was that, they were pretty sad how debt's ruining careers. And it's not just dentistry, it's medicine, it's law, it's a lot of other professions. And, I think people are under the misconception that, yes, it's a good living, but when you're starting $300,000 to $500,000 in debt, it's quite a hole to kind of dig out, especially when you're thinking about starting a family, buying a home, or buying a practice for that matter. So again, class of 2019, this was a survey that ADIA gave roughly just under 292,000, significantly higher for those who went to private schools, about 50,000, 70,000 less for those that went to public schools. And so here's kind of, the majority of folks were 40% were greater than 300,000 of those that were surveyed in 2019. So maybe the small sample here in this group a little bit better. And so there was a study done by one of our former residents who's now an oral and maxillofacial surgeon. And she did a study with the American Association of Oral and Maxillofacial Surgeons, and looking at educational debt and how it impacts them becoming an oral surgeon. And so here's some of the stats. So when they compared 2017, 2018 graduates versus 2010 and 2012, you can see that there was a significant climb in terms of educational debt affecting the practice that they were in, debt affecting the type of home they were going to buy, and affecting the decision to start a family. And so what we highlight was that nearly 43% had monthly loan payments greater than $3,000 per month. So if I was to take the $2 a minute, wage for an oral surgeon, that roughly works out to about 25 hours of work a month. And they found that, and again, 59% reported debt playing a role in determining the type of practice they were in and also where they lived. So, which was significantly higher than those in 2010 and 2012. Now, this is quite striking, was, how many of the people responded that it would impact their choice of career. And so, 23% said that they were unsure that they would have done that, of the 2010 to 2012, if they had that type of debt, and 20% were kind of rethinking the type of specialty that they would have gone into if they knew that their financial burden was going to be that high. So when we talk about debt, I think, and I took the results of the people that did this quiz prior to the first talk. And so here's the question. If you had a loan that is $100,000 and the bank agrees to charge 7%, and you didn't, let's say you were on a loan deferral program where you didn't have to pay, let's say you're in residency or something. So you just let it sit. What would the loan balance be? And so basically the answer is none of the above. And the reason why is because, the initial thought is to take 7% of 100,000 and multiply it by 4. But what happens is that, after year one, it's 107,000, and now you're paying 7%. You're accruing 7% interest on that 107,000. So we're talking about compounding interest. It actually works out. So only about 13% of the people got this question right, and the real answer would be about $131,080. And so some people, even though they've got loan deferral, if they're in a situation where their interest is accruing on the principal, they think it's a great deal that they deferred it, but then here you could see that it's kind of growing on a compounded rate. And so this goes by the rule of 72, and you can use the rule of 72 in determining your debt doubling time, but you can also use it in terms of your equity doubling time. If you were investing, and let's say your investments had a particular percentage rate, so it works both ways. So basically, if you take the annual interest rate and it's the denominator into 72, that will give you roughly the doubling time. So 7.2% interest rate. If you got debt that you didn't pay down, that debt's going to double in 10 years, right? 72 divided by 7.2. Conversely, if you invest your money and it's got a 7.2 compounded interest rate, you're going to double your money in 10 years. And so, and then of course, if you increase that percentage rate, you're going to decrease the doubling time. So, if you got a 9% interest rate, which is kind of unheard of these days at the moment, then you're going to have less than 10 years. So rule of 72, is a nice, quick, and easy calculation in the back of your head. And so I refer to Jimmy Turner, the physician philosopher. He writes a lot about personal finance, his big thing right now. He's also a co-faculty member with me now at Wake Forest University. He's an anesthesiologist. For all of you students that are looking to, just learn about personal finance, get this book. It's a great one. It's quick and easy. But one of the things that he says is that every borrowed dollar that you spend will cost $1.50 to $2 to pay off later. And so, in other words, for every dollar that you borrow, it's 1.5 to 2 minutes that you're going to have to be in your practice working. So think about that. So when we talk about student loans, and so those that are on the pay as you earn plan, eligible from a federal student plan, you get monthly payments that are generally equal to about 10% of your discretionary income, and there's a formula to determine that, divided by 12, and so then it's capped at a certain rate. And so going back to the ADIA website, they came up with the following assumptions, and I'm going to use these assumptions when I talk about different scenarios here. So somebody with the average $300,000 student loan debt, interest rates based on 2019 graduates, I know that's a little bit dated, no aggressive repayment, they just kind of did the minimum payments based on the terms, and that they earned about 180,000 again, which was about the average income in the ADA survey. And they're single on a family size of 1. So if the student were to pay back their loans in 10 years, higher monthly payments, over 10 years, they would be making just shy of $4,000 per month monthly payments, which works out to about a $469,000 total repayment for that $300,000 loan, and $169,000 of that is going to interest. So now let me go back to quantifying that to your time. So that $3,900 per month, if you were to take the average dental salary and then make it into after-tax take-home dollars, would translate to about 32 hours per month working. Or no, sorry, 65 hours per month working. It's 32 hours per month for an oral surgeon, based on the $2 per minute calculation. So 65 hours, so that's about a week and a half of your work going to pay down your student loans. So what about if you spread it out over 25 years, and it would work out to about $2,300 per month for 25 years, but then look at what the total repayment is. You've actually probably more than doubled what you've paid, because it's $694,239 of total repayment. And so this even is higher than Dr. Turner's 2 times rule for for debt. And so 300,000 goes back to your principal, and 394,000 is just paying the interest on the loan. And so again, this equates to a dentist working 38.5 hours a month. So that's 1 week of their work. And for an oral surgeon, about half a week of their work going to paying down the student loans. So you have to think about that. In terms of now public student loan forgiveness, I do talk about it, and it's really not an option for the majority of you. However, but I bring it up anyways because, you know, I'm a career academic. I've worked in universities and hospitals most of my career. I was in private practice for a short period of time. But this generally wouldn't apply to you if you're in private practice. However, I do have some residents that do want to go into academics. And so, you know, it's certainly a good option. And so if you work for a qualifying employer, a 501c nonprofit, which really, you know, encompasses hospitals, universities, you know, the VA, state colleges, public health clinics, certain things like that, and you still maintain your federal loan, you don't refinance it or anything like that, but it's all consolidated, and you make your public service loan forgiveness payments, you can get after 10 years, you can get the remainder of that loan forgiven. And so that's a big consideration. So I've got a couple of my former residents going down that path and pursuing that path. And so let's say using that $300,000 loan, if they would work for 10 years, make about $186,000 of payments. But then look at this, $380,000 is forgiven tax-free if they went this route. So generally, when you're in academics and you work for government, you're probably going to earn less than you would if you were in the private practice. But then what you want to do is kind of do the math. If it's something that you're considering, and you don't mind, you're pursuing a career in that, you can do the math as to how much are you giving up in salary, but then how much are you going to gain in loan forgiveness in year 10. So again, it's just one option. What about private loans? And so, we just did a comparison of what the loan interest rate, at least in last year, were. Federal was still generally, for the most part, lower, but 2.75 for undergraduate, 4.3 to 5 for graduate student loans and parent loans. There are situations where private student loan interest rates can be lower, but in order to get those good low interest rates, you have to have excellent credit. So, I think, a lot of times it's probably worth shopping around ever so often, during the lifespan of the loan, and seeing if you can get something better, from a private loan than you would from a federal loan. So it certainly is worthwhile to do that. So lower monthly payments and interest rates lower than the current federal interest rate. You can keep on refinancing. And I'll get to this question, in a second. Cashback bonuses. You can also get benefits from, from programs within the individual institutions. SoFi is one. You can apply to multiple companies. And by the way, don't get sucked into what the advertised rates are. They're always going to advertise the lowest one, but then you got to have impeccable credit. That may not necessarily reflect what you're going to get. Was there a question?
Yeah. I had a couple questions, kind of just thought processes on, so just kind of just doing like a quick breakdown, like if we, right, like kind of differential between, say, like low loan repayment, but if you're investing, if you're getting a higher return on the extra money you're investing versus what you would be paying an interest. What are your thoughts on that?
I'm going to cover that a little bit more next talk, but there's got to be, yes, there's a good balance, and then there's a good guideline. So, and it all depends. Yeah, it all depends on what's the delta into interest rates versus your returns, but it's also the risk that you're going to get on the returns. So, I think what you're going to find is when we talk about the waterfall and priority, like investing versus debt pay down,
Yeah.
You want to pay your higher interest rate debt first, and then your lower interest rate debt last. And then, in between there is where, and I'm definitely going to go into it much more detail in the next talk. So student loans actually, kind of fall towards the end because it is one of your lower debts, so I think it all depends on what's the spread, between, the cost of borrowing versus the potential earnings that you can get on your investment. So it's a great question, and certainly, certainly one I'm going to go into way more detail next talk. So,
and can I ask one more?
Sure.
Kind of on this kind of private loans versus federal loans, because I know there's some drawbacks to going to private. One of the main ones being that I know, like with federal loan debt, especially since our loan debt's pretty high, something to consider. My understanding is that, like with federal student loan, if I were to say pass away, my spouse would not be responsible for my debt.
Correct. There are advantages with federal versus
Right.
So interest rates, you don't want to just factor that in, because there's other things like that you definitely want to consider.
Yeah. But on that front, is there a way to kind of I guess refinance, but like keep them federal? Like, are you able to renegotiate your loan rate?
I don't, that I don't know. Because my initial thought is no. But I think you can consolidate. I don't know if you can refinance. But if anybody thinks otherwise, please speak up, or have experience doing otherwise, definitely speak up. But I know there's much more flexibility when it is private. You can keep on refinancing, as much as you want. So I think there's more flexibility to do that. So I don't know if it's definitively no, but you definitely have more leeway to do it with private. So no, I appreciate the awesome questions.
No, thank you.
So just kind of giving you the student loan interest rates, and I just pulled them up today. And so if anybody wants to look them up, they keep them pretty updated. Just go to this website right here, NerdWallet. So if you're ever kind of shopping around and looking to refinance, this just kind of gives you a good idea right there. So, so let's talk about credit cards. And so, in terms of credit card debt, this is, I pulled this data today. So as you can see, there was a huge spike in credit card debt right after roughly the global financial crisis. And it slowly increased up until 2020. And now why was there a decrease? It's because of COVID. And so COVID, everybody stayed home, and they were afraid to spend money, and so there was less usage of credit cards. We were all sitting at home, locked down. But as you can see, it's kind of trickling back up again. And it's certainly, we're talking about, what is this? We're approaching $900 billion, so $1 trillion of credit card debt. And again, remember we talked about how 21 trillion is kind of the gross domestic product of the United States. So it's a significant amount. So this brings us to our second question. Basically the question is, how many of you carry a credit card balance is really the question at the end of the month. And if you do, how much is it? Unfortunately, I don't get to see who answers what, so you can all stay anonymous. So, okay, I'll end the poll right here. I think the majority of you answered. So most of you are doing pretty good. You're paying it off every month. A couple of you do carry a small balance. One of you carries a small balance. I remember doing a coaching session with one of my former residents, and they carried a credit card balance, but then they also had a lot of money in the bank. And I was like, why, and I was like, why do you want to carry the credit card balance if you can pay it off with the money in the bank? And they feel secure having the money in the bank. And it's a psychological thing. They feel secure having the money in the bank rather than paying off that credit card, which is generating 18% or whatever interest. But they feel like they felt better having that. So what are the five factors that add up to make your credit score? And so most people got this right. And so your credit score, your credit worthiness, whether it's for student loans, whether it's for a mortgage, whether it's for getting finance for the newest iPhone, whether it's your car, they'll look at your credit score, your FICO score being one of them. And so there's a number of different things that actually determine it. So a big chunk of it is your payment history. So are you paying on time? Also, here's the other thing is, what is your utilization rate? So are you using too much? Or, to be honest, you can actually get penalized if you don't have any credit history of credit cards, even though you've got all the cash. So you can get penalized for both overutilization, having amount owed, a high percentage owed versus the amount available, compared to not having any or not using any. You may have one credit card and you never use it. Well, your score, it actually penalizes you. How long have you had credit? So this is one of the reasons why, I've been in the United States for almost 20 years, and I still keep the very first credit card that I opened when I moved here to the United States, because I would actually kind of get penalized if I were to close it. So you want to have the older accounts, and that's what the next point is. You want to have as many of the older accounts as possible, and then you get penalized for getting more newer accounts. And then the types of credit card, types of credits, 10%. So now, how does that differ for your credit report? Your credit report kind of goes over, what credit activity has happened, especially with identity theft and fraud. You want to make sure that you look at this on a fairly regular basis. So you want to see what are all the credit accounts that you have. So you want to make sure that somebody didn't get your social security number and open up an account and that you don't, that you didn't know you had. What's your credit history? The types of loans, and then how many times have you inquired for credit? And so there's soft inquiries and there's hard inquiries, and the hard inquiries are the ones that kind of penalize you. So we just recently are in the process of getting our home refied, and so that was a hard credit inquiry whenever we applied for that. So here's where you use these resources. Check this. I know a lot of the banks and a lot of the credit cards actually kind of give you this service where you can utilize it. So definitely take advantage of it and look at it minimum annually, maybe even better, several times a year. So when a credit inquiry is made, i.e. you apply for more credit or loans, your credit score increases, decreases, or stays the same. So the answer is decreases. So most people got this right. Generally, as your credit score increases, the interest rate you are charged on a loan, so when your credit score increases, it gets better. That means you get better interest rates. So it decreases. So most people got this right also. And so here's an example. So this is another good book, I Will Teach You to Be Rich by Ramit Sethi. I mean, the general rule of thumb, even though these aren't necessarily what the interest rates are, annual percentage rates are, but the take-home message is that, if you got a better credit score, the lower your annual percentage interest rate is. And if you do that, then that certainly has a significant impact on, the amount you would pay on a $200,000 30-year mortgage. And so somebody with a 620 versus a 760 and above is going to pay just shy of $100,000 more over the life of that mortgage because of the difference in interest rates. So that 1.5% makes a big difference over the life of that loan, over the life of that loan. So, so I just updated this. The average credit card annual percentage rate is 18.26% for new offers and 14.51% for existing accounts. So, so this is definitely ninefold worse, or 6, 7, 8-fold worse than student loans, or more than fourfold worse than what you get for a mortgage. Now it's apples and oranges, but this just kind of gives you an idea. So people that carry balances on their credit cards, you're paying a significant amount. Now, here's the interesting thing, and I didn't learn this until recently. And so that's number one. You get the annual percentage rate, so it's 18.26%. What you do is you divide it by 365 days in a year, and you're charged that amount on a daily basis, and it accrues and it compounds. So if you've got $1,000, your balance, and you don't pay it, it's not going to be $1,118 at the end of the year. It's going to be significantly more, because what they did was they took that 18%, divided it by 365, and then applied it on a daily basis. So it's deceiving. It grows even faster. Here's another thing. This is the part that I didn't know. The interest rates are actually calculated from the day of transaction. So let's say that you went on a shopping spree and you spent $1,000 on March 15th. Now that's going to show up on your April credit card statement. And, generally you're going to have until May 1st to pay off that April credit card statement, that for that transaction that you placed on March 15th. Now, let's say that you decide to carry the balance and not pay that April credit card in May. So you're going to get charged interest. Now, when do you get charged interest from? It is not from May 1st when the amount was due. It's actually going to be applied from March 15th, the day that you actually made that transaction. So they're going to take that 18.26 divided by 365 and multiply it by the number of days since March 15th. So and I used to think it was just based on the day that it was due, but it's actually going to be calculated based on the day of the transaction. So that even increases it more. So that's sneaky. But I didn't know that until recently. Now, I am an avid credit card user. I almost never have cash. So, but you got to have some discipline. The difficulty is that I think people, when they just swipe their card, the studies have shown that if you were to spend it in cash, you're going to end up spending less versus if you were just to simply swipe a card. So there is some discipline involved. Now, I use my credit card all the time. I pay it off at the end of the month. So you do want to use it for cash back. So, I've got, you got a credit card that gives you 1.5% cash back for every transaction. So, essentially, you're paying 98.5%, for really what your total, your total amount. Reward points, people are pretty good at hacking that. I'm not going to talk about that. Extended warranty of purchases, car rental insurance. So, every time you rent a car, usually they're going to ask you if you want to buy their insurance. And more often than not, your credit card that you use will have that insurance that the rental car company is trying to sell you. So you always want to look at what the benefits of your credit card are. And then protections from fraud. Sometimes they protect us too well. So if I'm traveling and I try to make a transaction, sometimes I get denied because they think somebody stole my credit card and went on a field trip when it really was me going on the field trip. So, so there is definitely good usage for it. Nice thing about it, I also like to be able to keep track of my spending. And so there's a degree of discipline involved. As long as you keep track, you pay them off on time, and you don't spend more than you normally would spend otherwise. So I'm going to move on to asset protection. So we talked about the different assets that you have: your home, your car, your savings, and your investments in your business that you normally would protect against in terms of your life versus your liabilities. And then the biggest asset is yourself, your knowledge, your skills, what you have to offer to the world, your earning potential. And so a good portion of this talk about asset protection is really, how do you protect yourself? So this leads me to the third poll. And when we talk about insurance, many of you are students, some of you are residents. What do you have all lined up for yourself right now? Life insurance, disability insurance, umbrella insurance, all three of them, two of them. Well, good. We got somebody that's got umbrella insurance. 10 more seconds. All right. So it looks like, 4 out of 5, or well, of the 5 people that answered, 4 of you have life insurance. 2/3 of you have disability insurance. Perhaps if some of you are, I know we got some dental students on the call, so perhaps it's a little bit early for you to get it. And then umbrella insurance, and I'm going to talk about these 3 different types shortly. I guess I didn't share the results here. So there it is. So the next question is, in terms of disability insurance, how much disability insurance do you think you need? So if something were to happen to you, you were to get injured and it takes you out of work, how much do you think you need for coverage? So whether you have it or not. I'll give it another 10 seconds. Okay. So let's see, we had 5,000 per month, 10,000 per month, and 15,000 per month. Okay. So thanks for your participation, the 6 of you that answered the question here. So disability insurance, when I was in dental school, we were inundated with the insurance salespeople. And, they were taking us out to, fancy dinners and, and I think a lot of times the decision was kind of made based on the person that you liked, to be honest. But this is now disability insurance is probably one of the most important insurances that you're going to buy. And the reason why is because a high percentage of individuals are going to end up having to use this. And so you definitely want to buy it as soon as possible once you start earning. And so good policies are for roughly about, $5,000 a month coverage. And the coverage payout, now, a lot of times the underwriters for these insurance companies are only going to provide you total coverage up to 60% of your gross income. And then the other thing though is that you want to also determine whether it's going to be a taxable or non-taxable payout. Now, the disability insurance that I bought when I was a dental student is a non-taxable payout. And so I can get that benefit. So let's say it was $5,000, it's really like getting $7,500 a month in income. So you want to look at that. And so the cost is about 2 to 5% of the benefit, which is considered high. So if you're getting this is early on, this is when you're young and healthy and just starting your career. It's about $250 a month for $60,000 annual coverage, or $3,000, $5,000 a year. Actually, that should have been, $3,000 a year you're going to spend to get $60,000 of annual coverage. So, which works out to about $5,000 a month. So other things you want to look for in your disability insurance policy is it own occupation? So, you want to see whether, if you can't do dentistry, will it still pay out even though you can go into another career and something else? There's some that are even more specific, like if it's to the point where you can't even do procedures. But let's say you decided you still work as a dentist, but you're teaching faculty at a school, so we had a faculty member when I was in dental school, that was collecting disability insurance, because they had own occupation disability insurance, but they were still working as a dental school faculty. So, so you want to make sure that it's got these nice specific stipulations. The other thing is guaranteed and renewable, that the company is going to, it's going to be given to you, and some insurance companies can revoke it, or non-renew it, and also non-cancelable. And then here's the other thing: you want to make sure that you have an independent agent selling it to you. So a lot of times these salespeople are actually working for the insurance company that they're trying to sell it for, and so they're not necessarily, their interest is not necessarily looking for the best or the cheapest product for you. And so you want to make sure that if you're going to buy it from somebody, make sure that you're not buying it from the Great West Life person that all they sell is Great West Life. You want to make sure you get it from somebody that's going to maybe perhaps shop around and give you the best rates. And so here's again, 1 in 7 end up using this at some point in their career. And so, unless you've got some other steady stream of income passively or a big nest egg, definitely having this is to your advantage, and it's a must. So other riders, there are certain things that you can add to the plan. These are called riders. So future purchase option, can you up it if your cost of living or your income goes higher? You want to make sure you have that. Does it have a provision to, if you were to be disabled, to still make retirement contributions? Because as part of your income. And then also, does it cover you for partial disability? So there's certain aspects of your job that you won't be able to do that may take you out completely. And that's a tough situation. I see it even with patients that, it's not, that they get partial disability that prevents them from being able to work, and now they're not getting disability insurance. And because the insurance companies are saying, well, you can do 20 or 30% of your jobs, but then how good is it to you if you can only come into work 50% of the time and you're feeling crummy the other 50% of the time? And so a lot of employers are not gonna recognize that or allow that, even though the insurance company that's covering you thinks that you would. So here's the other thing: waiting periods. So the shorter the waiting period, the more you're going to pay for it. The recommended one is a 3-month waiting period, 90-day. So what do you do for the 90 days that say you don't have income? Well, you got to make sure you have an emergency savings, some money set aside that will cover 3 months of expenses in the event that you are disabled. It's either that or you pay more for your disability insurance premiums every month. So next poll. I'm going to talk about life insurance. It's probably a little bit early to start thinking about this, but I just kind of want to get your ideas of how much life insurance do you think you need? Okay. 5, 4, 3, 2, 1. Okay. So we had a third of you saying $1 million, third of, 2 people saying $2 million, and a few of you said $3 million. So we didn't have any takers for $4 million or more. So so they didn't think that they're worth $4 million. So everybody thinks you're worth $3 million. But I remember the first time we got insurance, when I got married, say 16 years ago. Yeah, is it 16 years ago? I'm like losing track here. We got a $2 million policy, and then I thought about it. It's like, oh, I feel like I'm more valuable dead than alive. But yeah, we'll kind of go over the math on this actually in a little bit here. So life insurance. So why, excuse me, why do insurance agents get a bad rap? And so life insurance agents often receive 80% to 100% of the first year's policy premium as commission, and then smaller commissions over subsequent years. And so over the average life of a life insurance plan, they're going to get about 15 to 25% of what you pay. So that's a significant amount. And so they're probably incentivized to want to sell you more expensive insurance plans. And so I'm going to start with the most expensive insurance plan. which is whole life insurance. And so what is it? So what whole life insurance is it guarantees payment of a death benefit in exchange for your premium payments, and it's fixed for the life of the policy. And the premiums, when you pay premiums, so that's the amount that you pay to the insurance company, part of it goes to your death benefit. So that's the amount that is paid out to your heirs in the event of your demise. Part of the premium goes out to commissions and fees. So we talked about the 80 to 100% to your insurance, your insurance sales people for the first year, and then 15 to 25 over the life of it. And then also, managers of insurance, what they call floats, the money that's in a life insurance company, they have to manage it. What do? They invest it. They put it in assets actually in order to preserve the money. So there's fees associated with that also. Part of it also goes to cash value in the case of whole life insurance. So this is where insurance salespeople will kind of float it as a means of savings, as a vehicle for retirement savings, because some of it is cash that you can pull out before you die, or you can borrow against. So it's kind of a sort of a pseudo retirement plan. And so that's what they try to pitch it as. And so, so you get the death benefit, the amount that's given in the event that you die. Every time you put premium, all of those balances, your death benefit and your cash value goes up. Death benefit's capped at a certain amount after a number of years. What they do is they'll invest it and kind of give you a guaranteed rate. The interest may accumulate on a tax deferred basis, kind of in a way that that it does in retirement accounts, in tax deferred retirement accounts. So this is where they'll try to pitch it as a form of retirement savings, and there's advantages and disadvantages of that. So it's basically with people that are your maximum retirement contributions in the 401k and a Roth IRA may be exceeded for a number of high income earners. So they're looking for other methods that they can kind of put their money aside that they can access in their retirement later on. And so this is one option. And so what you do is you can either withdraw the money from the cash value or take a loan against it and use it for whatever you need. And so the advantage actually of let's say if you were to take a loan against it, let's say that the cash value was $1 million and you took let's use a smaller number, $100,000, and say you take a $50,000 loan on it from money that's yours actually. And let's say that there's a guaranteed growth rate of the cash value of 5%. Well, even though you've taken out the $50,000, they'll actually calculate the cash value at $100,000 plus 5%, as if you never took the money out. And so it's not like if you were to take it out of your retirement account. You can actually take out loans out of your retirement account, and then whatever grows in that retirement account is only going to grow, is really based on what's in that, what's actually there. It doesn't include the amount that you took out. If you were to borrow against the life insurance, the cash value of life insurance, it will still continue to grow, even though you've pulled that money out. And then what happens is effectively you're paying yourself back into the plan with an interest rate, with a set interest rate, whatever the terms are. So that's where the advantages of those are. You can also get the cash value if you decide to end the policy. Now, here's the drawback. It's very expensive. The premiums are very expensive. So I think I was talking to one of my residents the other day, and she was showing me a whole life plan that they were showing her, and she had to pay $20,000 a year. But I think it gave like $100,000 cash out benefit starting at age 65, and it was like $2 million payout or something like that. So the question you have to ask is, do you really want to pay that high premium, or do you want to use it for other things? Do you think there's other investments or other vehicles for building up your wealth that's better? The other thing is that not all life insurance plans are equal. Some have very high fees. So really, and a lot of times they'll try to make it very confusing such that you don't know what it is, or it's hard to really decipher it. So The other thing is that the cash value, you can't really access that cash value until a number of years. Usually it's like minimum of 5 years of paying premiums. Some are even higher than that. And then it needs to be spent while alive. So if you don't pull out, if you don't use that cash value and then you pass away, it's gone. The insurance company pretty much, it's pretty much stays with the insurance company. Now they will get your death benefit, but the cash value, you're not going to get it. Your heirs are not going to get that cash value, whatever it accumulates. So universal life is a form of permanent life insurance with a cash value account where the premiums are above the cost of the insurance invested. It's also called adjustable life insurance because it's got a little bit more flexibility. So it's kind of got characteristics of whole life insurance. You can increase or decrease the death benefits or increase the premiums also, but it also affects what, the death benefits are. Now, this is what's probably recommended, and this is probably by most individuals, and this is personally what I have, is term life insurance, and it's because it's much cheaper. And so, basically, what you're doing is you are providing coverage for a specific period of time for a fixed premium, but there's no cash value. So the only benefit in it is the death benefit. So in other words, the only way you cash out is if you pass away, so there's no borrowing against it. There's no pulling money out of it to fund your expenses in retirement, but the premiums are just significantly lower. And so, basically how much life insurance should you get when? And so this is taken out of, again, Jimmy Turner's book and some other sources. So if you're a resident, you want to have enough to pay off your student debt and maybe about 1 to 2 years of full income. So, roughly about 500,000, when you're a resident. Later on in life, let's say you have a family, you want to have enough to be financially independent in the event that something were to happen to you. So your family be independent, financially independent. So you want to be able to at least pay off all your debts. Have a policy that will pay off all your debts. So if you got a house, a car, if you got student loans, whatever, you want it to be able to cover that in the event something were to happen to you. And then also all future expenses. So $5 million is kind of a sweet spot. I think that's roughly about what you all answered you thought you need. And so for a $3 to $5 million policy, it works out to about $150 to $300 per month. So that's considerably less than a whole life policy in which, again, like the one that I was looking at yesterday, it was like, $2,000 a month, So how much life insurance do you need? Here's one formula from one source. Take your monthly expenses, multiply it by 12 months, and then multiply it by 25 years. And then you want to add up your debts. So you want to add up your mortgage amount, if you've got kids, how much is it going to cost to send them to college? Although a lot of times that's very hard to predict. Other debt that you may have, and then other non-forgiven private student loans. And yeah, like you said, federal can get forgiven, private doesn't. Now, if you've got some savings accumulated, then maybe you need less. And so if you've got some savings set aside, like a retirement account, or if you got savings from job that you had in college, you can subtract that. So whatever other money or income that you have, and then you would round it up to the nearest million. And so, ever so often on an annual basis, I recommend that you go through this formula because your situation changes. Also, monthly expenses are going to go up, even if you had the same monthly expenses every month. It's because of something which is really big in the news right now called inflation. So don't think for a minute that $5,000 a month of expenses this year are going to be the same as $5,000 of expenses in 20 years from now. So you also want to factor that in. Here's another easier calculation to determine life insurance is you take 10 times your annual salary and debt minus your amount of savings. So that's a little easier. But I still think the other one is much more much more accurate, because your annual salary may not necessarily be a good representation of what's your real monthly expenses are, or is what I like to call your monthly burn rate. But that's a nice, quick, and easy formula to determine. Lastly, I want to talk about umbrella insurance. So I know one of you said that you had this, and I'd like to illustrate this with a horror story. So what umbrella insurance is: extra insurance that provides protection beyond your existing limits and coverages of your other policies. So when we talk about other policies, we're talking about malpractice insurance, we're talking about auto insurance, we're talking about home insurance. So it can provide additional coverage for injuries, property damage, lawsuits, or personal liability situations that those other things either don't cover or you exceed that. And so here's the story. So my uncle told me about a story about, my uncle's a physician. He had friends who are physicians. They were retired, and one of them, they were retired, and one of them had an eye condition. And I think it was the eye condition that kind of forced them to retire. And so then they were driving home and they hit a pedestrian, and the pedestrian sued them. They found out that they were a physician. And then when they dug a little bit deeper, they found out that they were a physician with an eye issue. And so physician number one, so they were thinking, okay, great, a lot of money. I can get a lot out of them. Number two, they found out about the eye condition being one of the reasons why they, perhaps may have contributed to the accident. And then number three, they won. They won the case, and it was well beyond whatever insurance coverage, auto insurance coverage they had. And they ended up being liable for an amount that, and their personal assets were liable. So they had to, their savings accounts were liable, their extra savings were liable, the equity they had in their home was liable. So it was just miserable. So things like this are the reason why you want to spend a very little amount, $200 to $700 per year, for umbrella insurance. I think we pay $400 a year for $2 million of coverage of umbrella insurance. So I bring this up because it's something that's really often overlooked. So I'm going to spend the last few minutes talking about financial advisors. And so if anybody has listened to Jim Dahl, the white coat investor, he says that your financial advisor, should you get one, is going to be the most expensive thing you're ever going to have. More expensive than your college tuition, more expensive than your home. It's the most expensive. It's the biggest expense you're going to ever have. And it sounds outlandish when you say that, but I'm going to go over the math as to what he meant by that. And so, first of all, you want to know how your financial advisors are paid. And so the biggest one, the most common one, is what they call assets under management. And so they'll charge 1% to 2% of your annually of your assets under management, is like a typical fee. And when you're a student or just beginning your career, or your portfolio is small, that you're thinking, well, that doesn't make a difference. Well, if I don't, if I only got a few $1,000s in my portfolio, they're not going to make much. But it compiles, and I'll go over the math of how that compiles. Other financial advisors are fee only. So they say, okay, I charge by I charge by the hour, or or pay me $1,500 and I'll set up your financial plan and get everything under. And at the time, people are kind of put off by the several $1,000 upfront fee, because they're thinking, well, if I only have $10,000 and I only pay 1% of that, that's much less than the $4,000 or $5,000 that it costs us to pay that. But to be honest, I think fee only is probably your best bet. Now, fee based is kind of a hybrid. They get commissions from products that you invest in, or brokerage fees, trading fees, although that's getting less and less these days. So number one, if you're interviewing a financial advisor, ask them, are they assets under management, fee only, or fee based? For the longest time, my financial advisor, I had no idea. I thought he was just a good guy, and I still have him. My original one from Canada, which, he manages our Canadian accounts. I mean, I'm thinking, how's he making money? Well, he makes money from putting our money in what they call loaded mutual funds. And I'm going to talk about that in lecture 4. And so whenever he puts his money into that, he gets a percentage of that. And so, and I only really understood that recently. So that's an example of a fee-based financial advisor. So here's the other. So ask them if they're assets under management, fee only or fee-based. Number 1. Number 2, are they your fiduciary or not? And I'm going to go into what that means. Fee only financial advisors, like I said, charge a flat fee of, several $1,000s for the one-time creation of a plan. And then maybe they'll charge by the hour for you to meet up with them once a year, which is going to be much less than actually somebody that's an assets under management fee. And then, typically if they're an AUM person, they're going to do usually 1%. And you're thinking 1% doesn't sound like a lot, but it is. So let's use a typical assets under management financial advisor. Let's say you're 28 years old. Most of you, most of the residents, when they're done residency, that's when they're starting their career. They've got about $5,000 of starting savings, and they're contributing $2,000 monthly, so about $24,000 annually. And we want to figure out what's their balance at age 67, assuming that they get 6% return on their investment annually on average. So let's say we just did this and contributed and got 6%. And so their end portfolio balance would be $2.8 million. Sounds great. Now, what if you got a financial advisor? And so there are some financial advisors that also charge assets under management, but they're called robo-advisors. And what they do is they kind of use AI to kind of automatically algorithms to kind of automatically determine what's the best allocation for you. Generally, their AUM fees less. It's about a half. So think about it. So let's say they're charging a half of your total assets every year. So a half minus 6% minus a half is really a 5.5% return over the lifespan. How much are they going to cost you? So your robo advisor is actually going to, instead of getting you 2.8 million, is going to get you 2.3 million at the end, because you're not getting a 6% return. You're actually getting a 5.5% return. And so you've actually, that robo advisor over the life of the managing your portfolio has cost you $464,000. Now, what about if you had your typical live person financial advisor that charges 1%? That 2.8 million goes down to 1.9 million. So that financial planner, they don't get that amount, but it's cost you $864,000 in total. So that's more than your student loans, more than a house. Well, actually, these days, maybe not. But this shows you that 1% has cost you that amount. So in terms of a fiduciary standard, are they fiduciary? Well, what is a fiduciary? If they're a true fiduciary, everything that they're doing, all the advice that they're giving you, all the money that they're putting you in, is done so in the best interest of the client. And they're registered with the Securities Exchange Commission or a state securities regulator. And they are typically compensated by assets under management fees. However, if you find out that whatever they're putting their money in is not in your best interest, or at least it's not in the spirit of your best interest, then they can be sued. Now, there were laws that were introduced several years ago trying to make it compulsory, and the financial management industry fought this hard. And the reason why is because a lot of people I'll go into it into the next slide. A good portion of people are not necessarily fiduciaries. That advertise themselves as financial advisors or financial planners. Now they say, well, I'm not a fiduciary, but I do follow the suitability standard. So stockbrokers or broker-dealer representatives, insurance agents, people that are insurance agents but say that they're financial planners, they're not fiduciaries. So what they're selling you and what they're putting your money in is not necessarily in your best interest. Their incentive is to put their money into their product so that they can get compensated. And so, yes, there is some sort of regulation. They must be suitable. That's a pretty vague word based on their financial product. But they're not required by law to act in their client's best interest. And they're often compensated by commissions that put them in the conflict with the interests of their clients. So if they had the choice to put your money in product A or product B, but they know that product A is going to get them better compensated, they're incentivized to put their money into product A. And so I still think there's more people that follow this than the fiduciary standard. So if you're interviewing, you definitely want to ask them that. So don't mistake a salesman for a financial advisor. So financial advisor red flags. Number one, they work on commission. Number two, they give you a lot of free stuff. So these are the folks that are going to have the nice, big, fancy dinners, and you're thinking, oh, they're great. I'm going to sign up with them. They only discuss one type of investment vehicle, or for that matter, they only discuss one type of asset to invest in. So they only talk about stocks and bonds. Well, what about alternative investments? What about other things? And usually they'll try to discourage you from putting your money in other things other than whatever their core assets that they manage you in. The other thing is they don't discuss or emphasize debt pay down as part of your plan. So their incentive is to put as much money into their product, and they're going to tell you, well, why, and then they'll use tactics, like sort of like the question we had earlier. It's like, well, why do you want to pay down your debt when I can give you greater returns? Put it in my account. Yeah. So they have a larger nest egg that they can draw from. And they don't discuss the relative merits of other vehicles. So health savings accounts, Roth IRAs, 529 college savings. And what they usually they'll kind of push you into one of these things, but they won't give you the big picture. And this is part of the reason why I'm here, because a lot of times the financial advisors are the ones that are going to want to give you that talk, and they're not going to give you the whole picture. And I'm hoping to give you the whole picture. Now, how can they help you? So number one, yeah, I demonstrated that if you were to do it yourself and get 6% versus have a financial advisor that gets you 6%, you're going to lose a significant amount. But the question is, if you did it yourself, can you get the returns that the financial advisor is going to get you? So asset allocation, they'll generate returns. Number two, they'll kind of look at your big picture if they're a true fiduciary, and they'll kind of plan for your goals. And hopefully it's the holistic approach. It's debt pay down, savings, retirement, investing. And then they'll educate you about the different vehicles and the different asset types. They're not just going to push you in stocks and bonds or the mutual fund that, the 10 or 15 mutual funds that they want to put you in. And they're true counselors and giving you advice. How do you allocate your capital? What's a good investment right now? Here's where their biggest value is navigating the market ups and downs, because the average retail investor underperforms most indexes because they get scared when the market goes down and they sell. And then when the market goes up, they buy when everything's very expensive. And even the biggest professionals don't do as well as the indexes. And so having a financial advisor is the person that's going to try to talk you out of, like March of 2020, when stocks dropped 20% and everybody thought that the world was ending. And I was scared too. They're going to be the one that's going to talk you out of selling all your stocks, and of course, since the bottoms of 2020, the stock market has gone up and doubled since that. So, and the other thing is, if you don't have the time or the to manage your own portfolio. So again, buyer beware, ask the right questions, make sure that they're fiduciary, determine what their fee structure is, so they can be helpful for you. But if you really get educated, it's not very hard to do it yourself and get a good return. And you just got to get educated on that. So take home pearls. I talked about, again, income. Income doesn't equal wealth. Net worth isn't the whole story either. So you got to manage your cash flow. We're going to talk a lot about cash flow management next month. Asset feeds you, liabilities bleed you. Cash flow is the key. That's the lifeblood. of your day-to-day living. So you could have a lot of high net worth, but it's tied up. It's not liquid. It's not generating any cash flow. You could have a $2 million house that's mostly paid off, but you could still be home poor. So that's, and I'm going to talk a little bit more about that next time. You definitely want to reduce your liabilities. You want to protect your greatest asset, yourself. So we talked about disability insurance. We talked about life insurance. We talked about umbrella insurance. And financial advice is the biggest expense you will have, but they can help you. So choose wisely and ask the right questions. So this concludes this month's talk. Next month, we're going to talk about cash flow. The following month, we're going to talk about investing in wealth building. So I'm going to stop share here. I'm going to actually turn on my camera if it works. There I am. And I'm going to answer any questions if you have any. Or not. And so, yep, ADA, some comments here. I'm just looking. So ADA offers $50,000 of life insurance free for dental students. Take advantage of it. I will definitely send out the recording of the lecture. And, did everybody get everybody was able to access last month's? I posted it on YouTube. So I post all of them in YouTube, so you certainly will get that. But does anybody have any questions about insurance?
Hey, Joel, I've got a question.
Yep. And who's that? And who am we talking to?
This is Golden Vu.
Hey, nice to meet you. I know I'm glad.
Nice to meet you, sir.
Yeah, I appreciate. Thanks for showing up. And chime in because this is somebody that's quite experienced and can speak from the private practice standpoint. So.
Oh, thanks. Well, it's my first time joining one of these sessions. Now, is this geared towards more dental students or new grads?
Yeah, so we've geared this closer towards early career dentists, but a lot of the stuff is still useful because a lot of this I kind of learned fairly late, or paid attention to it, or actually, I think I had good financial advisors, and my wife was pretty good on top of these things, and so I didn't really pay much attention to it, and so I just started learning it. I give it to, we just want to educate our folks, since I'm a residency program director, to kind of get, learn all the things that I wish I learned back then. So, so this series is targeted towards them. Yeah.
Well, it's excellent. I think what you're doing is excellent. I really enjoyed it, and I think what you're doing is great for the newer dentists.
Yeah, and hey, man, I'm so glad you jumped on. Thanks for your support, and I really looking forward to kind of trading ideas, because I think we have some pretty good banter in the Facebook group that we're in. So so I'm really glad I met you. So looking forward to chatting with you more.
Yeah, I agree. Yeah, I look forward to next month's session also.
Any questions or comments? Students, hey, you guys, really give you props for being here tonight. Residents, give you props for being here tonight. Again, a lot of this stuff I just learned over the last few years. So, you guys, I give you props. Get literate, get financially literate, because again, like I said in the first lecture, this is going to determine, how much you're going to work, where you're going to work, what you're going to do. If you don't learn this, then you're going to be a slave to your situations, and don't be a slave to your situation. Get it. And the only way to combat that is to get educated. So, I know I went way over, but I appreciate all of you for sticking around. So thank you tonight for joining me, and be on the lookout for the recordings, and be on the lookout for the announcement for the next session. And I think it's going to be April 27th. So appreciate you all for being here. Have a good night.